Hi, my name is Christopher. Welcome to this journey through taxation. Today we are going to study the chapter, which is Basics of Income Tax. In this chapter, we'll explore how residential status affects taxation, the five heads of income, and calculation methods for each. We'll also learn about exemptions, deductions, and tax treatment under different scenarios like house property, business, capital gains, and other sources. Finally, we'll cover the deductions available under Chapter 6A, which help reduce tax burden. Introduction to Income. Income tax is a direct tax levied on individuals, businesses, and entities. It applies on income earned during a financial year. This slide sets out the scope of the module, residential status, income heads, calculation methods, and deductions. Income tax is central to government revenue and personal financial planning. Understanding its basics is essential for every taxpayer. Residential status and tax liability. Tax liability in India depends on a person's residential status. There are three categories: resident and ordinarily resident, ROR, resident but not ordinarily resident, RNOR, and non-resident, NR. RORs pay tax on global income, RNORs on Indian income plus some foreign income, and NRs only on Indian income. Conditions depend on days of presence in India. This classification decides the scope of income taxable in India. Residential status, tax implications. This slide shows tax treatment under each status. For ROR, all income, Indian and global, is taxable. For RNOR, only Indian income and income controlled from India are taxed. For NR, only income earned or accrued in India is taxed. Understanding these differences prevents double taxation or undertaxation. It is the starting point for any tax calculation. Heads of income. The Income Tax Act divides income into five heads. These are salary, house property, profits and gains from business profession, capital gains, and other sources. Each head has unique rules for computation. Income is classified to ensure fairness and clarity in taxation. This structure simplifies assessment and enforcement. Income from salary includes basic pay, allowances, perquisites, and retirement benefits. Examples are DA, HRA, transport allowance, bonus, gratuity, and pension. The formula is gross salary minus exemptions equals net taxable salary. Salary is taxed on a due or receipt basis, whichever is earlier. This ensures income is recognized in a timely and accurate manner. Salary, exemptions and deductions. This slide details exemptions. HRA is exempt subject to conditions. Actual received, rent paid minus 10% of salary, or 40-50% of salary depending on city. LTA is exempt for 2 trips in 4 years within India. A standard deduction of Rs. $50,000 is available to all salaried individuals. Professional tax levied by states is also deductible. These reduce the taxable portion of salary income. Income from house property income comes from ownership. Self-occupied property has nil annual value. Let-out property is taxed on gross annual value, minus municipal taxes and deductions. Deductions include 30% standard deduction and interest on home loans. This ensures fairness in taxing property income. House property, special cases. Special cases add complexity. From FY 2019 to 20, taxpayers can claim 2 self-occupied houses as nil annual value. Vacant property is deemed to be let out and taxed accordingly. Unrealized rent can be deducted if conditions are met, but if later recovered, it is taxed. For co-owned property, income is split in proportion of ownership. These provisions prevent misuse and ensure balanced taxation. Profits and gains from business or profession. This slide explains business profession income. It covers income from business activities or professional services. Expenses allowed include rent, salaries, depreciation, and bad debts. Disallowed expenses include personal expenses, income tax, and large cash payments. Books of accounts must be maintained for certain cases. This ensures accurate reflection of profits. Profits and gains, presumptive taxation. Presumptive taxation simplifies compliance. Section 44A(d) applies to small businesses with turnover 1 2 crore, taxing 8% of turnover, 6% for digital. Section 44AE applies to transporters with 10 vehicles, with fixed presumptive profits. Section 44ADA applies to professionals like doctors and lawyers, taxing 50% of receipts. These schemes reduce compliance but are limited in scope. Capital gains. Concept. Capital gains arise from transfer of assets like land, shares, or jewelry. Assets are classified as short-term or long-term based on holding period. Real estate becomes long-term if held over 24 months, shares after 12 months. Gains are computed as sale consideration minus acquisition cost, improvement, and transfer expenses. Long-term gains get indexation benefit using cost inflation index. Capital gains, tax rates, and exemptions. Short-term gains on equity are taxed at 15%. Long-term equity gains above Arsaus 1 lakh are taxed at 10%. Other short-term gains are taxed at slab rates, and long-term others at 20% with indexation. Exemptions include reinvestment in residential property, Sec 54, agricultural land, Sec 54B, bonds, Sec 54EC, or new house, Sec 54F. Certain transfers like gifts or inheritance are exempt. These provisions balance taxation with investment promotion. Income from other sources. This is a residual head. It includes interest income, dividends, winnings, gifts, and rents from machinery. Some are taxed at flat rates, such as lottery winnings at 30%. Deductions are allowed only for expenses like collection charges. Agricultural income from abroad also falls here. This ensures no income escapes taxation. Deductions under Chapter 6A, Section 80C to 80CCD. Section 80C allows deductions up to R1.5 lakh for investments like life insurance, PPF, EPF, ELSS, tuition fees, and housing loan repayment. Section 80CCD covers NPS with an additional R50,000 deduction under 80CCD 1B. These deductions encourage savings and long-term investments. They reduce taxable income and promote financial discipline. For most taxpayers, 80C is the most commonly used deduction. Deductions. Section 80D to 80G. These cover health and charity. Section 80D allows deductions for medical insurance premiums, $25,000 for individuals, and $50,000 for senior citizens. Medical expenses for seniors can also be claimed. Donations to approved charities under 80G allow 100% deductions. These provisions encourage healthcare protection and social contributions. They make taxation socially responsible. Deductions. Section 80 TTA and 80 TTB. Section 80 TTA gives deduction up to Rs $10,000 for interest on savings accounts. Section 80 TTB extends this to senior citizens, up to $50,000, covering both savings and fixed deposits. This ensures seniors get higher relief on bank interest. These deductions benefit those with modest savings. They make taxation fairer for low-income earners. Other key deductions. Several other deductions exist. Section 80E covers interest on education loans with no limit. Section 80EEA allows additional R1.5 lakh deduction on home loan interest for first-time buyers. Section 80GG provides deduction up to $60,000 for rent when HRA is not received. Section 80U offers relief for persons with disabilities. These ensure inclusivity and support for special cases. Summary. Residential status and heads of income. This summary brings together earlier concepts. Tax liability starts with residential status, which defines income scope. Income is classified under 5 heads to compute correctly. Each head, salary, house property, business, capital gains, other sources, has rules and exemptions. Deductions then reduce overall taxable income. Together, they form the basis of income tax calculation. Summary. Capital gains and deductions. This slide recaps capital gains and deductions. Short and long-term assets are taxed differently, with indexation benefit for LTCG. Exemptions encourage reinvestment in houses, land, and bonds. Chapter 6 Dykes A deductions promote savings, insurance, education, and social welfare. These reduce net liability and align taxation with economic priorities. Mastery of these rules helps optimize tax outcomes legally. Closing perspective. The final slide closes the chapter. Income tax is not just a financial burden, but a civic duty. At the same time, it offers ways to save through smart planning. As future professionals, you must distinguish legal tax planning from evasion. Mastering basics like residential status, income heads, and deductions sets the foundation for advanced taxation. This knowledge empowers both compliance and strategic planning.